Good evening, participants. Welcome to today's webinar on Fixed Income Market Insight by UTI Mutual Fund. We had two major events since our last webinar in January, which is interim budget for FY25 and RBI monetary policy that was concluded yesterday. In the interim budget, the finance minister prioritized fiscal prudence over populism, unlike what most expected being an election year. However, when we talk about the monetary policy, it was mostly in line with what the market participants were expecting. In terms of status quo on the repo rate, however, they were expecting slight dovish forward guidance, which was not there, and the RBI retained its stance of withdrawal of accommodation. To discuss more and to share the insights on the bond market updates and perspectives on interim budget, policy, etc., we have with us our head of fixed income, Mr. Anurag Mittal. Post his initial remarks, we will take up the Q&A. You can keep posting your questions on the link provided anytime during the webinar to make the most of this opportunity. So without further ado, I will now hand over to Anurag. Thank you, and let's have an insightful session together. Over to you, Anurag.
Hello, good day, everyone, and welcome to UTI's Market Insight webinar for month of February 2024. So we'll start with the global trends which are influencing domestic as well as global central banks. We'll discuss the key insights from the budget as well as the RBI policy and the way going ahead. So to start with the global trends. So if you look at the two slides, two charts on the slide, the left-hand side is a JP Morgan Global PMI, which depicts the manufacturing as well as the services PMI. If you look at the major trajectory after topping out, for example, for services PMI in about May 23, it has been moderating. And if you look at the manufacturing PMI as well, it has been moderating since the end of 2022, largely as the pent-up demand of the post-pandemic period, kind of played out, and as the services opened up, there was a certain spike. But as the lagged impact of tight interest rate works through the economy, economic activity is moderating. There was a slight uptick during the last month, but largely the reason has been, major upticks in a couple of economies, which was also dependent on some seasonal factors. But we will need to see whether it sustains meaningfully or it continues to moderate at the pace at which it was moderating during the last calendar year as well. The reason why we believe that these upticks could be one-off and economies may not take off meaningfully. If you look at the right-hand side of the slide, which is the global GDP by sector, and if you look at the manufacturing, GDP growth, it had kind of plateaued out around 2% during the end of 2023-24. And if you look at the non-manufacturing side or the services side, which had been doing quite well in 2023, had also started to fade out and converge with the manufacturing sector. So we are not really seeing a slowdown, but we are possibly seeing a moderation and a slightly longer term moderation in global economic activity in both manufacturing and services. If you look at the commodity and food index, that's largely been flat. So despite economic activity, picking up, the commodities have kind of stayed range bound, mostly because of low demand impulse from one of the biggest commodity importers, which is China. So as China continues to grapple with its real estate slowdown and overall lower consumption, that's leading to lower commodity demand. And overall, despite the intermittent supply chain disruptions, commodities have not really taken off. If you look at the food price index, that has started to go up in the middle of last calendar year, But if we see the trend in the growth rate, that's largely been flat in the last couple of months. So that also is a slightly comforting factor for most of the central banks that commodities, both hard commodities as well as food prices, have continued to be flat despite supply chain disruption. So preferably they would like for this to sustain for a longer period, to have a greater confidence before easing on interest rates. One of the major events which has happened in the last 1 month is the disruptions in the Red Sea area, which has led to a sudden spike in shipping cost. And of course, it leads to a logical concern that what would be the impact of these disruptions on global inflation, given that we also saw a similar disruption during the period of COVID, and we saw a major inflationary pressure. So to really, compare and assess that what's really the impact of these Red Sea disruptions. So one of the ways to look at the disruption is to look at the chart on the left hand side, the topmost chart, and it broadly shows the shipping route from Shanghai to Rotterdam, which is typically the most favored route taken from China and Europe. And why this route has been taken is because these two regions account for a large part of global, shipping destination. What's really happened is because of the disruption around the blue line, the shipping companies are using the Cape of Good Hope. As we can see from the chart, it adds to a longer time period for the shipping companies, and consequently it increases supply delivery times, which leads to final changes in the price, and of course it also leads to higher shipping costs as well. So as we can see on the left hand side, but on the bottom part of the chart, the freight rates, which were hovering around $2,000 comfortably, are now doubled in just last 1 month. They have gone to $4,000, which brings in the comparison that what will happen to global inflation as well as how bad it is compared to COVID. So if you look at the chart again, the same, the left hand side bottom chart. During COVID, in fact, because of the overall disruption, it's not just that the route in the blue line was under question, the disruption was all around. The actual freight rates were even almost three times higher than what they are today, despite all the time taken to go to the Cape of Good Hope. So it's not the same as COVID, because during COVID there was a disruption at major port destinations. For now, it is a localized destination. And more importantly, when we have to see in today's world, what exactly is the share of shipping cost as part of total goods. So as we can see on the right-hand side of the chart, while it differs from an economy to an economy depending on the import intensity of its products. So of course, for economy, which is highly dependent on imports, may have a higher share of shipping cost compared to economy, which is much more localized. But if you look at the GDP weighted average for the world, it's just around 1.5%. So, and if you look at for many parts such as Euro area, US, Asia, EMs, etc., it's even lower than 1.5%. So broadly, it's the shipping cost are minuscule of the total goods, cost in most of the economies. Secondly, even within the freight cost, only half of the total shipping comes from the sea. So broadly, one can see that from a weighted average basis, only 0.75% of total goods production or cost of production gets impacted by these shipping disruptions. So as long as these disruptions don't escalate further or they don't continue for a very long period of time, we do not really see an impact on major, goods inflation. Of course, central banks, and rightfully so, are right now taking caution, given that inflation has been on the higher side for the last 2 years. So they are not, willing to react right now. It's low economic data and willing to ease policy rates with these kind of, supply chain shocks. But we think that as long as they don't escalate further, the large impact on goods prices are likely to be moderate. Coming to the next slide, as we were talking about inflation, as we can see, from the inflation continues to moderate from its peak levels in the summer of 2022, which we saw most of the economies printing close to, double-digit inflation. However, it is the final mile of getting inflation to target, which may require a higher economic impact, which broadly means either a labor market or a general economic slowdown. So while this inflation gives policy space for central bank to cut interest rates from exceptionally high levels, but nevertheless, till inflation reaches their target, which is close to 2% for most of these developed economies, we do not see interest rates going back to pre-COVID levels for them. Looking at the 10-year sovereign yield movement across key economies. So while we saw a very strong rally in bonds in the month of November as well as December, January was kind of a giveaway time where most of the bond yields, barring China, which is experiencing strong disinflation and a slowdown, most of the economies' bond yields went up. The reason being, so when we started the year, there was a widespread expectation in the bond market that, given that there is a greater confidence on disinflation, central banks may start moving soon, and we may start to see rate cuts from March itself. With economic data coming in quite reasonably strong, there is a pushback against expectations of very early rate cuts, and that has led to repricing in the bond yields in the key economies. Coming again to that, we were discussing in the previous slide that how the evolution in the rate cut expectations has happened. If we see on the right-hand side of the chart, which is the market implied policy rate forecast, which is basically derived through interest rate swaps, if we see around the middle of the Jan, the amber line was at its lowest in recent times, and because market participants were expecting the quantum of rate cuts to be higher, as well as early rate cuts. And if you can see, at the end of the January, those expectations have come down. So both in terms of the magnitude as well as the timing, those rate expectations have cooled off, as we can see in the left-hand side of the chart as well. In the financial conditions index, which is broadly a sum total of your credit spreads, equity, and bond valuations, that's also gone up, although not sharply, but broadly, if you look at from the lows of December, it has also gone up marginally. So broadly, market participants as well as global central banks are closely watching the balance of inflation as well as growth. And as inflation continues to moderate, as long as the trajectory remains how it has been for the last 6 months, there is a strong possibility that central banks will start to cut interest rates. While the timing is slightly uncertain, because ultimately it depends on assessment of an individual central bank of its growth inflation dynamic, but largely it's safe to say that we are likely to see interest rates easing in the later part of the calendar year 2024. Coming to India trends, as we know, yesterday was the RBI policy where the MPC voted 5:1 to keep the policy rate unchanged at 6.5. The stance was retained at withdrawal of accommodation. The external MPC member, Professor Jayant Verma, voted against the stance, as well as voted for a 25 basis interest rate cut. And of course, the thought process behind the voting for an interest rate cut will be revealed in the MPC minutes, which will be released at the later part of this month. But overall, if you look at the tone of the MPC policy, the growth outlook was positive. In fact, as we can see on the bottom table on the right-hand side, compared to the, if you look at growth rates, from 7% growth expected in FY24 in December 23, the RBI revised the forecast taking into account the NSO estimate of 7.3. Even if we look at FY25 growth estimate for Q1 of next fiscal year, RBI revised the forecast from 6.7 to 7.2, from 6.5 to 6.8, and 6.4 to 7. So broadly, on an average, RBI is projecting a 7% real GDP growth, which is slightly higher than most of the professional forecasters, as well as multilateral agencies like IMF, World Bank estimates. Of course, RBI has taken comfort from improving household consumption as inflation continues to come down, from strong government's commitment to capex, as well as improvement in agriculture growth as well. If you look at CPI inflation projection, RBI compared to 2024 inflation estimate for 5.4, CPI inflation has projected at 4.5 for FY25. The overall tone of the policy was in line with the December 23 policy, where RBI mentioned that they need to be actively disinflationary to ensure that inflation aligns to their 4% target. So just to give a background, there was a widespread expectation before the MPC policy that RBI may change stance, or they may bring up an action plan to address the tight liquidity. So while the liquidity number is not very materially negative, the problem the banking system has been facing for a while now is the skewness of liquidity, which has kept overnight market rates about 20 to 30 basis higher than the RBI policy rate. So there was an expectation from RBI that RBI will probably do something. But if we look at RBI's action since January, RBI has been intervening intermittently through fine-tuning operations to provide liquidity to the banking system. It has also undertaken various measures, even in the December policy, to provide liquidity during the weekends. So RBI kind of separated between the needs and wants of the bond market. So while RBI is trying to ensure that a predictable liquidity which the market needs, is provided actively, but what the market wanted, that stance change, which would have probably provided a greater clarity on RBI rate outlook. RBI decided to retain the policy flexibility given the uncertain, global cues, as well as RBI probably wants to wait for the trajectory of inflation to pan out as per its projection. But if we look at the big picture, whether the market participants were disappointed yesterday or not, the big picture is that RBI is expecting an inflation of 4.5% for FY25. So even if there is not a material slowdown in growth for India, as long as inflation is moving broadly along the expected lines, we do expect interest rate cuts of 50 to 75 basis in this calendar year itself, given that inflation is moving materially close to RBI's 4% target for most of the quarters. Typically and historically, RBI has maintained a real rate that is a difference over the expected inflation of somewhere between 100 to 150 basis points. Typically, in a slowing economy, RBI prefers to maintain a slightly tighter real rate, and at times of economic expansion, RBI prefers to maintain a slightly wider real rate band. So even if you are assuming 1.5% real rate for the economy, assuming no major slowdown, it still translates to at least a 50 basis policy rate cut in this calendar year. So we think that we can focus on the big picture, while the timing, like we said, just like the global central banks, the timing for RBI is ultimately their own individual assessment versus the market assessment of the demand supply dynamics in terms of inflation or the growth dynamics. But largely, the end goal, I think, is quite consistent with market expectations. If you look at how they are, looking at overall, assumptions behind their inflation. So broadly, RBI expects core inflation to remain stable. So as we can see, the core CPI, which is the red line on the left-hand side of the chart, it has been consistently coming down since 2023 as supply chain issues are getting resolved. So broadly, RBI continues to believe that this broad-based ease in core inflation will continue. RBI also took comfort from softer commodity prices. Mind you, we did discuss that how commodity prices have been range bound despite intermittent supply chain disruption. So given that commodity prices are staying soft, overall supply chain is quite stable and smooth now. They do expect core inflation to continue to be healthy and to be on the downward side. Of course, the shock that they expect probably on headline inflation, they expect can come from either geopolitical and supply chain shocks, which we also discussed that in case they get further escalated, it could result in more meaningful inflation disruption or higher food inflation due to any extreme weather events. We believe if we look at even last year, with the government giving free food grains to a large part of the population, and government also imposing various export-based as well as stock-based limits, we think the impact of food supply shocks, just like last year, will probably be absorbed by the fiscal authorities, and hence food inflation is likely to remain moderate. We also have adequate buffer stocks, especially for cereals, which may keep food pressures under check. So while there could be one-off events going ahead, given the erratic weather patterns, but we do not believe that it changes the inflation trajectory very meaningfully compared to RBI's estimate. If we look at the CPI diffusion index, which is broadly the weight of constituents, which is higher than 5%, if we can see the right-hand side of the chart, it is showing a consistent decline since 2022, and even the last number was a decline, from November level. So broadly, which broadly shows that inflation is not generalized. It is concentrated at few items, and once the supply chain issues resolve in those items, we are likely to see a broad-based behavior of disinflation. We talked about food inflation being a source of concern for RBI. If you look at the Rabi sowing, which is giving a lot of comfort to RBI both on growth and inflation. If we look at the left-hand side of the chart, so broadly the blue line depicts the area sowing till end of November. The amber line depicts the area sown under till end of December, and the gray line shows the area sown under Rabi crops till 31st January. So if you look at wheat, it has shown a remarkable improvement. So compared to area sown till November, which was actually 5% negative compared to previous year, by January it has totally recovered, and in fact higher than previous year. If you look at pulses, while it is still negative at 3.7% compared to previous year, it is a reasonable improvement from 8.5% in November to 3.7% now. If you look at oil seeds, again we saw large volatility in oilseed inflation post the Russia-Ukraine geopolitical escalation. And we see there has been a meaningful improvement in areas sown for oilseeds as well. So if you look at the total, Rabi crops, and if you look, compare the area sown compared to November, from a 5.5% negative YOY number at the end of November, now the area sown has almost ended flat as at the end of January, which is quite comforting to RBI, as well as it should lead to some pickup in rural consumption as well. If we look at the river storage capacity, that's still slightly negative compared to last year. So last year the capacity was about 19% higher than the 10-year average, which is now fallen to 6% because of erratic rainfall and a weaker rainfall. Hopefully if the monsoon is normal this year, this should also autocorrect going forward. Coming to the budget, so the budget, the expectation, given that it was an interim budget, that there may not be major announcements. From a fixed income perspective, what we really, when we look at the budget, we broadly look at the assumptions behind the budget, whether they are realistic, and pragmatic, both on the expenditure as well as on the revenue side. So if we look at the assumptions behind the major tax items, they look to be quite conservative, because if we see one of the major determinants of tax collections is the growth in nominal GDP. So given that the growth in nominal GDP is estimated to be about 8.9% for FY24, which should increase to 10.5% in FY25, given that the GDP deflator, which is basically a combination of CPI and WPI inflation, should increase, should also result in better tax collection growth compared to FY24. So if we look at the corporation tax, that's assumed at 30% growth, which broadly translates to a tax buoyancy of 1.1, which is not very aggressive. Even on the income tax side or the GST, the growth is broadly in line with the nominal GDP growth. So if we look at direct tax collections as a percentage of GDP, FY25 BEE is broadly as a largely in line with the previous year, which was also a year of very weak nominal GDP growth due to lower wholesale prices. So probably as wholesale inflation and hence GDP picks up, this 6.6% can reasonably be slightly better in FY25. If we look at the total expenditure, so if we look at the subsidy payments, it has been reduced from 4.13 lakh crores for FY24 RE to 3.8 lakh crores for FY25 BE, largely coming from reduction in fertilizer subsidies as fertilizer prices are falling globally, and hence government has to commit lower amount to fertilizer subsidy. If you look at the budgeted capex, so government had assumed a 10 lakh crores budgeted capex in FY24 BE, aims to achieve a budgeted capex of 9.5 lakh crores for FY24 RE. Although it is slightly lower than the FY24 budgeted estimate, but if we compare it with the FY23 actual numbers, which was 7.4 lakh crores, the 28% odd growth is a very meaningful improvement and has been a very positive impulse to GDP growth for FY24, and which should carry forward in FY25 as well. So if you look at as a percentage of GDP, the 3.2% for FY24 RE has been quite strong and high in last 10 years. In fact, the government wants to even top it and bring it to 11.1 lakh crores in FY25, implying a growth rate of 17% almost and 3.4% as percentage of GDP. However, when we want to look at the total growth impulse provided by capex, we need to look at the capex of the government as well as of public sector undertakings, and that is why we are looking at effective capex. So we look at effective capex as a percentage of GDP. It is around similar to FY24 RE, which is close to 4.4%. From a bond supply perspective, it's quite positive, which broadly means that given that capex from public sector undertakings could be slightly on the lower side, that broadly implies slightly lower bond supply as well. And again, it's positive from a point of view of fixed income. If we look at overall, fiscal deficit of GDP, it has come down from 5.8% to 5.1% for FY25 BE, which was considered as a major positive for the bond market. Mind you, during COVID, government had come up with a medium-term fiscal consolidation growth path, where they had projected a 4.5% fiscal deficit as a percentage of GDP by FY26. Given that we were already at 5.9% for FY24, there was an apprehension whether government will be able to show a credible consolidation path, which the government has presented, despite taking very, conservative assumptions both on the revenue as well as on the expenditure. And the biggest takeaway from the bond market perspective was this gross borrowing number, which you can see on the right hand side of the chart. So as you can see, on the right hand side on the bottom chart, the net borrowing number has largely been constant or consistent compared to FY24 RE. And if you look at the actual maturities of government bonds in this fiscal year, it was about 3.6 lakh crores, which would have translated to a number close to about 15.4 lakh crores for FY25. But by using the GST compensation fund, which government had collected to repay the borrowings it had undertaken during the pandemic to compensate the states, government was able to adjust its maturities of about 1.2 lakh crores against the GST compensation cess, thus resulting in a gross borrowing of about 14.1 lakh crores. This was lower than most of the market estimates, and hence this led to a strong bond rally because given the inflows expected due to the bond index inclusion, the demand supply dynamics, in fact, even become better, which the market was expecting before the budget. So again, to recap, the budget, whether in terms of its assumptions on the revenue or expenditure, was quite conservative. The fiscal deficit number of 5.1 was again lower than most of the consensus estimates, which were around 5.3, 5.4. And the gross borrowing number was the biggest positive surprise from the budget, which broadly reduces duration supply for the bond market and can overall lead to compression in term premia because of overall lower supply. So both from the policy as well as from the budget, I think the takeaways are that RBI, despite uncertainty on food inflation, is expecting a 4.5% inflation for FY25, which gives RBI some policy space to cut interest rates by 50 to 75 basis points once global conditions turn favorable. If you look at the fiscal deficit, it's very credible, and the borrowing numbers continue to be lower than market, which improves the demand supply dynamics quite meaningfully. If you look at the credit growth and the deposit growth, that gap has started to narrow marginally as credit growth as moderates in the last fortnight, and deposit growth has picked up as banks have started to pass on the cost in terms of higher deposits to investors, which is leading to slightly better pickup in deposit growth. And we believe it is this number which will drive the money market rates and not just RBI stance on liquidity, because to fund this aggressive credit growth, banks have had to use the banking system liquidity as well as keep deposit rates on the higher side, which is leading to skewness on the liquidity front. So probably once the credit growth stabilizes, which typically it does in the first half of every fiscal year, we should also see money market rates going down. If we look at this chart on system liquidity and MIBOR rates, as we can see from the orange line, typically MIBOR has been above policy rates for a while now due to the high government cash balance and, like we discussed in the previous slide, skewness in the banking system due to the high credit growth. Largely when our tax collections goes away from the banking system to government cash balance, which comes back to the banking system when government starts to spend. So till the government starts spending, we expect this MIBOR rate to be slightly on the higher side. This is what the bond market was expecting yesterday, that probably RBI will do something durably to address this issue. But RBI has clarified that their stance has nothing to do with their stance on liquidity. The primary tool of transmission is their policy rate, which they want to ensure that the banking system is also able to pass through to the borrowers in the loan market, which they believe is slightly incomplete. As far as the MIBOR is concerned, they are broadly looking at MIBOR being on an average close to the policy rate, and hence they are intending to provide term repo or term reverse repo at various points of time to ensure that the liquidity needs of the banking system are met. Of course, when rather than having automatic programs, and when RBI is providing liquidity from a case-to-case basis, it may result in some volatility in the near term. But on an average, we believe that liquidity should be comfortable. As the government spending picks up in the next quarter, this should further improve. On the trade deficit, nothing much to report there. Broadly, it is in line, with seasonal patterns. It has continued to moderate, which bodes quite well for our FX reserves as well as for INR volatility. If you look at FITD trade deficit for 2024 to date, it is about 188 billion compared to 212 billion in 2023. So broadly, due to commodity prices being softer, we are able to maintain a moderate level of trade deficit, which should be easily funded, by the high invisibles as well as high FPI flows, which we are likely to experience in the current and the next fiscal year. Coming to the bond yields, if you look at the valuation, and when we were seeing the bond yields across major economies, last month, what we saw is that, apart from China, most of the financial markets saw uptick in bond yields. And if you look at coming to India, in fact, despite, in the anticipation of a higher borrowing number from the budget, bond yields actually fell. So if you look at, especially on the short to medium end of the yield curve. So while, the 1-year T-bill rates went up slightly from 709 to 715, and AAA 1-year rates remained largely stable. If you look at the 3-year rates, whether in the GSEC or the AAA corporate bonds, or the 5-year rates, whether again GSEC or corporate bonds, or also 10-year rates continue to fall down as the overall inflationary pressures have continued to come down, as well as market perception of demand supply for next year has improved quite significantly given the expectations of FPI flows. So as we saw in the previous slide, given that our external account has been quite stable, it has resulted into stability in the INR as well, which has resulted into very active FPI interest in bonds as well, which has improved, the bond valuation. So despite global bond yields going up, domestic bond yields have remained range bound and in fact have come down. And so this is, I think, the difference being there in the current monetary cycle, that India has really stood out on very prudent fiscal as well as a very prudent monetary policy, and that has resulted in our bond yields outperforming global bond yields. So broadly on the outlook, again, to summarize, what we saw starting from the first slide itself, that the post-pandemic pent-up consumption has been fading out. The very exceptionally high interest rates as well as fiscal consolidation has started to reflect in current indicators. In overall headline inflation continues to reset downwards much faster than expected. From the budget, the budget delivered on all expectations, whether it was fiscal consolidation, like we discussed, right? 5.8 going to 5.1, and whether you look at the reduction in gross borrowing, or having very credible assumptions on tax as well as on expenditure. From the policy, RBI does not want to give away their stance right now, rightfully, till they see a slowdown in growth momentum, or they see a sufficient confidence in inflation falling towards 4%. However, even if inflation falls around 4.5%, the base case for 50 to 75 basis rate cuts remains strong. Investors who are looking at a 6 to 12 months horizon and consider allocation to low duration money market strategies an investor more than 12 months horizon can consider allocation to moderate duration strategies.
Thank you, Anurag, for sharing the insights and outlook on the fixed income market. The webinar is now open for Q&A, and I invite the participants to share the questions in the link provided and make this Q&A as engaging and informative as possible. While I wait for the questions to queue up, let me begin with the questions that we have already received. So the first question goes like, with the recent MPC meet, the markets are assuming that fixed income market would now follow a buy on dip mindset, reacting to demand supply dynamics. So what are your views over here?
I think for investors, it's very difficult to time the market, and it's very difficult to determine what's the dip, given the very uncertain outlook, and especially things can change overnight. What we saw during last March as well, that suddenly, post the crisis in the regional banks in the US, suddenly the outlook for the financial markets changed very drastically. What we believe is, given that inflation outlook is quite stable, investors can consider allocation without waiting for any meaningful correction.
Sure. Thanks, Anurag. Moving on to the next question. What is your view on the corporate India's revenue trajectory for fiscal year FY 2025, as the estimated growth is between 9 to 10%? So will it remain range bound, will it improve, or will it moderate?
So corporate is not a homogeneous, sector, and different corporates have different drivers. For example, let's say an oil and gas corporate will depend on how oil prices behave, which may be great for an oil, and high oil prices would be great for an oil and gas corporate, but they may not be great for a FMCG, for example, because it will typically result in higher raw material prices and lower consumption. But typically at a macro level, corporate revenues tend to follow nominal GDP. Since we are expecting a higher nominal GDP in this fiscal year, which is about 10.5% compared to 8.9% for FY24, we do expect corporate revenues also to improve going ahead. And that's why, if you look at the tax collections from corporate taxes, government has assumed a higher tax rate growth of 13% compared to 11.5% in FY24.
Thank you for this answer. So the next question is regarding the policy. Market participants were expecting that RBI would address liquidity deficit in the policy, either by way of stance change or decisive action plan. However, RBI dismissed any need for any action right now. So how do you see liquidity moving in the coming months and impact on the lower end of the curve, lower duration or money market strategies?
Right. So I think RBI did not dismiss the need for the liquidity. What RBI did was that what they clarified is that their monetary policy stance is really, targeting the interest rate and ensuring that there is a complete transmission of their policy rate towards deposits as well as towards loans. As far as liquidity is concerned, they are quite ambivalent about it. And they prefer to, do fine-tuning operations, which they have been conducting in the last 2 months, to provide, liquidity needs of various banks and PDs, as well as they have taken various regulatory measures as well for liquidity on weekends as well, for example, to ensure that liquidity remains ample for the banking system. The problem probably which the banking system is facing right now is a very high credit growth compared to the deposit growth. And that is what has led to spike in money market yields, because typically to fund that high credit growth, there is a very high issuance of CDs or retail deposits as well. So probably once that corrects, which typically it auto corrects in the first half, because usually first half of fiscal year is a lean season for credit, and second half tends to be slightly a busy season because of the festival demand, etc., etc. So we do think that once credit growth moderates in the first half of next fiscal year, uh, you know, uh, money market rates should also stabilize. So investors who are looking to invest for more than 3 months or even up to 1 year can consider low duration to money market strategies, because one, they are giving them a reasonable accrual right now. Plus, they also get an opportunity to participate in capital gains once the rate cycle turns. If you look at the absolute level of money market yields, 1 year, PSU bank CD is trading somewhere between 7.8 to 7.9% right now. If an investor prefers, they can lock in these rates at these levels. So if you compare it to the average inflation, which we foresee next year, even RBI is foreseeing a 4.5% inflation. So if you look at the real rates, perspective, it is quite attractive to what we have seen so far.
Sure. So, like you mentioned, that RBI also made a point that transmission of rate hikes is not yet taken completely. It's yet to take. So, why do you think that this transmission is so slow? It's not yet happened.
Like RBI also explained in the press conference, why the transmission has happened in deposits. It's not happened in loans, because only about 50% of loans are floating rate and the rest are fixed rate. So as those fixed rate loans also expire and those get refinanced, they will probably get refinanced at higher rates, and hence RBI is probably waiting for banks to pass on that cost to customers to ensure that economic activity gets aligned to the policy rates at which RBI wants.
Sure. The next question here is, inflation numbers globally are now moderating. However, they are still above the comfort zone of most of the central banks. Economic indicators such as non-farm payroll, it has started signs of moderation in the some slowdown in the economy. Also, there has been recent case of one regional bank which in US which was downgraded. So, do you think global banks, considering these points, will start to look at pivoting in the near future?
So global banks typically are pivoting, and most of them have pivoted. So if you look at the Fed commentary or commentary from the European Central Bank, the commentary has been that they want to cut interest rates. They are just waiting for sufficient data and sufficient confidence to move. And I think so. So the pivot has already happened as far as global central banks are concerned. So that is, they are not looking to hike interest rates, but they are looking to cut interest rates. So the first part has happened. I think for now, the working assumption behind most of the central banks and the economists are that we are unlikely to see a deep recession in the near term, or a deep financial market correction in the near term. So barring a very deep financial market correction or a economic recession, central banks are likely to cut interest rates, but just to maintain a sufficient real rate gap. It's not that they are likely to go back to pre-COVID level. So for example, for the US, where the inflation target is 2%, but the headline CPI has been close to rather than 3%. So probably, which gives policy space for the Fed to cut rates, but not go all the way to 2% and below till they see inflation going there meaningfully. So I think the pivot has happened. It's just the matter of time. Irrespective of what's happening in the banking system. Of course, if there's a major crisis in the banking system, that timing gets pushed forward, then ahead. But largely, we do think that rate cuts are likely to happen in the second half of the calendar year.
Sure. So the next question here is, what in your view is holding central banks to start rate easing cycle? How long it, like you already answered to this, like how long it can take the rate cut cycle to start, but what's holding the banks to start the rate cut?
So I think given that the abnormal behavior of commodities and labor market in the last 2 years, if you look at the unemployment number, for example, in the US is at its 50-year low, yet wages are consistently going on the higher side. If you look at the geopolitical disruptions, we have been seeing repeated geopolitical disruptions in various commodity markets. So broadly, central banks want to be sure that despite all the disruptions, economies are able to adjust to the new reality and inflation is moving along the expected lines before taking the plunge. So ultimately, markets evolve. So when Russia-Ukraine war started, there was a widespread expectation that how will the commodity flow, especially in the goods where both Russia and Ukraine were quite dominant, but how will it flow to the rest of the world and how will commodity prices behave? Ultimately, things worked out, and oil prices, which were all the way to 120 post the war, they came all the way back to $80, and are hovering there. So of course, markets evolve. But they are waiting. But the markets can evolve the other way as well, so that some disruption can become more permanent, and it can lead to higher inflation in the medium term as well. So they are waiting for a better time so that there is more clarity, more confidence, and hence, it may take a couple of more months for them to get that confidence. The second important point is in a period where growth is quite stable and strong, it's not that they have to act urgently to support growth. So when the growth is being quite stable, they can show some patience, and they are not really behind the curve, because typically what the criticism that central banks face is that either they were too ahead of the curve or too behind the curve. So when growth is quite stable, inflation is still not really the target, they are not really behind the curve. So they can take a couple of months.
Sure. So before moving on to the next question, I would again remind our viewers that you can keep posting your questions on the link provided to you. So the next question is also again related to the rate cuts. Some of the central banks in the emerging markets, they have started rate cut ahead of Fed. For India, discussions have, it keeps going on that India is getting coupled from the global economies. Does this mean globally also other economies are now decoupling from US?
So the emerging markets which have cut interest rates ahead of the Fed, they had also started to hike before the Fed. And many of them are, export-oriented economies, which have benefited from the high in commodity prices. So their tax revenues, their fiscal deficit, their overall inflation has come down. So we don't think it's comparable to India, because India, if you see, started to hike post the Federal Reserve. So probably we think RBI they may prefer to wait for global conditions to become more favorable before it embarks upon its monetary easing cycle.
Sure. The next question is, additional monies have started coming into India due to inclusion of JPM bond index, which is due in June. So how is it going to impact the yields? Has it started to happen, the impact on yields? And how will it impact the fixed income funds? And is there any change that you have started taking, as in UTI mutual fund has started taking into its fixed income funds, considering this?
So in the near term, it results in flattening of the yield curve, because typically when you see flows across the 5, 7, 10, 14-year space compared to the natural demand, it results in compression of term premia. So the typical term premia, which we used to see between, let's say, the repo rate and the 10-year yield or the 5-year yield, that may compress in the near term. Ultimately, in the longer term, what matters for term premia is inflation expectations and expectations of a predictable monetary policy. So while in the near term, we do believe that till we see the whole of flows to come in, we may see a flatter yield curve. But ultimately, what will really shape the yield curve is the expectations from monetary policy, is expectations of a stable inflation, which will really drive, the yield curve. So, for example, if you see the US, where the curve is inverted, because the expectations are that the near-term inflation will soon dissipate, and the long-term inflation is still will be moderately lower. So I think once the expectations start to build in that inflation is likely to well behave in India, we are also likely to see a flatter yield curves than we have seen. From FPI flows perspective, we believe it's overall structurally it changes the demand supply dynamics for India at least for the next 2-3 years. So typically, especially post-COVID world, the bond market has relied on RBI OMO to fulfill the demand supply gap between the government borrowing and the requirements of the banking plus the insurance plus the pension and the mutual funds. But there was always a gap. So with this bond inflows coming in, that gap gets fulfilled. And it also places an additional burden of responsibility on RBI to be more external looking as well. So till now, RBI was more internal looking. And of course, their overall conduct of monetary policy will be towards domestic considerations, but they cannot be very outlier to the rest of the world, given that now we are part of the index and the flows in the currency movement may also take cues from how our monetary policy is behaving vis-a-vis the rest of the world.
Sure. In the interest of the time, please allow me to take 2 more questions. What are your views regarding floating rate funds at this time? And along with this, I will add 1 more question. Should investors start looking into adding duration to their portfolio, investing into longer duration? So what are your views over there?
So on the floating rate funds, as we have clarified previously as well, what matters for the investor is to look at the net duration of any floating rate instrument, or similar way the floating rate fund as well. So while the coupon of the floating rate security is dependent on the benchmark, what matters for the total performance of the security is also duration which it is carrying. So in a way, floating rate paper and by extension the fund needs to be looked at as a combination of the coupon and the mark-to-market movement, which are totally two independent things. The coupon may depend on the benchmark and it may benefit from a rise in interest rates, or in the other side, it may it be in a disadvantageous position because of foreign interest rates. The MTM remains the same. So as long as the duration is in line with the investors' risk appetite and investment horizon, they have to consider the floating rate strategy as per its merit of the interest rate as well as the credit risk that fund is taking. One way to review floating rate position or a floating rate fund is to look at the benchmark of the floating rate fund, which gives a signal to the investor regarding the characteristic of the fund. So for example, if the benchmark of a floating rate fund is a low duration index, that typically means that the floating rate that strategy will behave in accordance with the duration band the benchmark is representing. So that's how floating rate funds should be considered. It doesn't really matter whether we are on the downward interest rate cycle or the upwards. Largely the duration which matters. Regarding your second question, whether investors should invest in long duration strategies given that we are expecting interest rate cuts, we believe it's ultimately a function of risk appetite of an investor, and that how much of a risk reward ratio an investor is willing to undertake. And to us, what we really like on the yield curve is moderate duration. So if you look at the valuation of the yield curve today, a 3 to 4 year AAA bond is trading somewhere between 7.8 to 7.9%, whereas today a 10-year GSEC is trading around 7.1%. So even if the rate cut cycle gets slightly delayed, the investor is not really losing on accrual, and investor is earning reasonable accrual even on a high quality fixed income product. And of course, this moderate duration also gives them a sufficient chance to participate in the MTM gains when the rate cycle turns. So the difference between the 10-year GSEC, for example, and the moderate duration part of the yield curve is quite meaningful right now. It's around 60 to 80 basis points. So you are getting the benefit of a reasonable accrual. Plus, given the uncertain world that we have seen in the last 2 years, you can't say for sure whether the rate cut cycle will start next month or it will start in next 3 to 6 months. So this gives you a certain element of comfort, at least in terms of accruals. That's something which we like. So we believe that funds like short-term funds, corporate bond funds, banking PSU funds, which typically maintain moderate duration, are suitable for investors from a risk-reward perspective.
Sure. Thanks, Anurag. At this time, I would like to thank our participants and viewers for being part of today's webinar on Fixed Income Market Insight. Your active participation and thoughtful questions have made this session very engaging. Please share your feedback on the link provided to you. Special thanks to our speaker, Mr. Anurag Mittal, for the valuable insights. As we conclude, we encourage you to stay connected with us for future events and updates. Your interest and involvement make our webinars really successful. So have a great day ahead. Thank you.
Thanks a lot, Avi. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.